Hello and welcome to Fintech Focus TV with me, Toby. Today I am delighted to be joined by Simon Dove. Simon, how are you?
Hey Toby, I'm very well, thank you. Great to be speaking to you, given the lack of seeing and speaking to people that are all experiencing it at the moment.
Anything we're doing to just to grab on to a bit of human contact is great, isn't it, at the moment? But listen, thanks so much for sharing your time. You're in a business. I think it's a really interesting business at the moment. I've been hearing nothing other than really solid reports about what's coming out of Tower. But for those people who don't know too much about you guys and yourself and a sort of general background, can you give us a little bit of introduction?
Yeah, of course, thanks. So Tower Research is a global quant-driven trading firm, market making across multi-asset, so equities, fixed income, FX, metals, and multi-asset in terms of our profile. And I guess from our side of things, we've evolved as the landscape's evolved around electronic trading. Our founder spotted an opportunity to really kind of provide an automated market making type models across different asset classes, and really we've kind of built the business over the years around that. And I think built, to your point there, a very reputable reputation globally to actually achieve that.
Yeah, I think that's it's one of those sort of scenarios where it's no one wants to be unempathetic, but everything I've heard about what you guys have done has been the right sort of things. There's certain companies out there who I think have ridden this this storm so far with far better than other people. Some of it because of the market position, but some of it from doing the right thing. Tell us a little bit about how you guys have approached everything that's been going on.
Yeah, and I guess you're talking specifically around the crisis more than the other. Yeah. And actually, I guess a lot of the foundation work that has happened over the years has really kind of been, the crisis has been a testament to how the market has evolved, since 2008. Clearly, the electronification of different products and different asset classes has been a big driver for firms like us and some of the providers. And I guess the end investor has seen the benefit of that in terms of ultimately better spreads and lower cost of execution and a better experience. And I guess the investment in technology, good risk management is obviously key. And I guess the forefront of that is also regulation and control. The firms like ourselves who've invested over the years in that have now seen that playing out in terms of our profile and the contribution we're able to make to the market. And I guess alongside that, innovating with the market to ensure that we kind of continue to provide the liquidity that they demand of us and expect of us, and ultimately kind of grows the overall pie for everyone and builds a better ecosystem across the different asset classes.
You mentioned different asset classes, and it's interesting, where we've seen certain fare better than others recently. I think there's been some interesting sort of plays that you've made in the equities space, if I'm not mistaken, at the moment.
Yeah, and it's a great point. And particularly in Europe, and it's a very topical discussion at the moment. There's a huge amount of regulatory scrutiny in certain areas. Some of it rightly so. Some of it, I think, probably misguided for various reasons. But going back to MIFiD I in the equity space, MIFiD I was about introducing competition to the European landscape. And competition is a good thing. There's no doubt about it. It ultimately delivers a better market for all the participants and ultimately the buy side and those originators who really we want to be delivering best execution and the best quality liquidity to them. MIFiD I introduced the SI regime, and subsequently in January 2018 we saw MIFiD II evolve again, where we saw changes in the equity landscape, driven really by the regulator in certain circumstances, having scrutiny around some of the broker dark pools and some of the other mechanisms that were being used. As part of that, and no great surprise, as the market always does, the innovation that came out of that really was firms like ourselves and some of our peers providing systematic internalizers with our own liquidity within that. So this is really the only client business that we run, or counterparty business that we run. So we have a venue which is regulated as an SI, and we have various different requirements from the FCA in terms of maintaining that. One of the great things, and one of the reasons why I joined Tower, is the governance and the regulation and the importance of that we hang around everything that we do. So what we looked at was the MIFiD II really was removing some of the optionality of liquidity. So it's natural for the market to innovate. Firms like us, as I say, we source technology, matching engine technology, or people built their own matching engines. And we created what was a bilateral access for our sell side counterparties to consider our liquidity alongside their other liquidity options and evaluate whether really that liquidity was additive to what the ecosystem was currently offering. And actually the metrics have really came out to indicate that the positivity and the scrutiny that rightly is being put across the SI regime, because it's allowed us to be much more transparent in the way that other mechanisms simply aren't. That scrutiny still continues, and it is a little frustrating because quite often, and this is not new for our industry, we have to look beyond the point that's being made to understand the agenda behind what people are trying to do. And so far, the sell side and the buy side have been very clear that systematic internalizers from an equity ELP perspective have been an additive addition to their liquidity landscape.
Yeah, I think that's really interesting, and there's been a whole sort of evolution, I think, of the of the industry, as a whole. If you're looking at everything right now, and seeing where different parts of different industries have reacted pretty well, I would say that the electronic markets have probably come out pretty strongly from everything we've been seeing at the moment. What's your take of the industry's reaction to the crisis?
Yeah, that's a great point, and I think that one of the things, however we look at that, the reaction to the industry, the reaction by the industry, I think has to be commended. The process has been challenging on a number of different levels. I guess the disruptive nature of a change in the way that we work and the way we operate. The fact that I and you are sitting at home at the moment, and the way that people have been able to deploy staff. And trading expertise into a much more sort of distributed model, really I think plays a lot, and the seamless nature of that happening really plays and is complementary to a lot of the work that we've all done over a number of years. BTP, DER, all these things have been incredibly important to us and have been defined by the regulator as being important, quite rightly so. So we've seen a change in the landscape. I think the other important point you mentioned there, which is it's not unusual to see significant volatility and uptick in volumes in the way that we've seen over the last few months, and it has been phenomenal how you see this. And clearly, a lot has been talked about how the electronic markets have performed in these markets, because historically there's been challenges or potentially criticism of that. I think if you look across the asset classes, electronic markets, the way that ELPs like ourselves are able to interact and provide our liquidity has really proven to be very effective. And you've only got to look at some of the numbers out of some of the fixed income platforms like Market Access and TradeWeb to sort of see how these models have really stood up to time. And I think validated how important a part of the market electronic is to that.
Yeah, I'd absolutely agree. I think the companies you mentioned, plus a number of others, have all seen a really interesting robustness to it. Look, in 2008, you saw a very very different sort of reputational damage hit to the financial markets, as we all know. 2020, I think you've probably seen the financial markets take a massive step forward, both in terms of trust and validation as a whole, in terms of what we're seeing. And I'm really interested around this sort of, we spoke about this last week, this whole concept of volatility and how short-term volatility can be a very interesting thing for the markets. Long term, there's obviously some impact that can happen into that. What's your sort of view of what the short-term and long-term impacts of everything we're seeing at the moment will happen in the marketplace?
Yeah, and look, there's a lot of people much more intelligent than me making some calls on this and providing some really, really interesting data and analytics. Sadly so. And I guess and just finishing off on linking that and to the point we made earlier, it's very important to sort of recognise the work that the primary exchanges and the providers there have also delivered. The resilience around their technology and their capacity to absorb this enormous uptick in volume across all the different asset classes has to be recognized and complemented, because it's such an important, certainty and sustainability and stability of this technology is incredibly important. I think volatility is, volatility in the way the market reacts to it across different asset classes has evolved and changed over the last years. I mean, we've seen events that have happened that in previous years you've seen a huge uptick. The market absorbs news in a very different way now than it ever did before. But clearly, I think the uncertainty, which is what the market dislikes, whether it's political or any other things that are are somewhat interesting to see how the different assets go. And there's a lot of talk around that. So look, in the short term, we've obviously seen higher volatility and some of that hanging around, less so now. I think from my perspective, the next few months are going to be really interesting. And I think my concern, I guess, away from our industry is what the underlying impact is going to be long term. I, as well as many of you guys listening and watching, will have friends that are in different industries and different things. You know, I'm truly concerned about how they fare in this sort of slow but sure recovery. Signs are good so far, and I consistently try and be positive about what we're seeing, because there is some really good signs. But we're still in what is unprecedented situation with a timeline that seems very uncertain at the moment for everyone, not just in our market.
Yeah, I'd agree with that. There's it's so difficult, isn't it, depending on who you talk to, and I think there is no real expertise out there for for whoever you're talking to, be it the sort of top economist in the world to the pub economist who's having a very different sort of view of things. But look, what I think is what I think has been pretty clear is, even when you talk about the sort of severity of the drops of the markets and how quickly they've recovered, has been phenomenal, really. When you look at it, and there is that sort of breeds some confidence into what we're doing. I think gradually seeing people come back has done that. We sometimes forget, don't we, about the situation we were in before all this happened with Brexit and the election at the end of last year, and everything that sort of happens still around that, creating volatility in its own right around all these things. It's a very interesting storm of situations that hopefully has that sort of positive press to see us starting to move into the right direction around it.
Yeah, and I guess just to add to that point, it's clear in a lot of the data that we're seeing now, and the impact that firms like ourselves from an electronic ELP perspective are having. The data often is directing towards the fact that we provide a level of stability there in those uncertain times. When historically, if I think about my days back in the LSE, when I worked in sort of 2001 through to 9. There was a huge amount of criticism, which continued over the last kind of 10 years as well, about firms like ourselves and the role that we play. I think the electronic component is providing some stability in these uncertain times, and data is justifying that. And data is really what we should all be using to evaluate, make judgments and make decisions. Quite often that emotional element, which I think is becoming sometimes too much of certain parts of our industry, has to be removed, and we have to be data driven in terms of that thought process and decision making.
I'm really interested in that data side, because it's been one of the things that people have been speaking about for a number of years, quite obviously. But what seems to me to have been the norm is that people talk about data but don't actually have hugely brilliant strategies behind it, and it sort of has the danger of running into sort of tech buzzwords in a similar way to cloud did for many years at the same sort of stage. So a lot of talk about we need to use data, but not an awful lot of clever use of it. What you're talking about there is actually genuinely taking steps forward to utilize data in its best possible form, right?
Yeah, absolutely. And I mean, we're seeing evidence even now. Recently, we had an ESMA consultation, which came out with some relatively kind of inflated numbers to sort of drive the discussion. And as a market participant, the importance of data and how we use that to influence our decision and our regulatory landscape is incredibly important. So it's becoming more and more evident that we need to work harder at making data better and more broadly available, so that it can feed in and drive decisions. There's a lot of work being done in Europe around sort of quality data, pre and post trade, particularly around post trade, flagging of data, and in a way that will normalize and standardize it across different venues, so that we can really use it to judge, measure, and make a decision. And that's incredibly important as we become more electronic as well. Let's be very clear, if you look at the evolving landscape around data and its usage, the quality of it is incredibly important to a market operating effectively. So there's a lot of work being done there, and I'm far from an expert in that space, but equally understand the value that brings to us. Yeah,
look, I think it's natural sort of segue there. Is you touch on the regulatory side with ESMA and everything that's been going on. There's been so much change around regulation over the last few years. With everything that's been happening now, and what you're seeing in the marketplace. What impact do you think we're going to see on the recent regulatory focus?
So I guess from the really fascinating discussion on the regulatory side, particularly now around was the recent ESMA consultation, which was really asking the market to make some decision or input some feedback in terms of some key questions. You know, some pretty radical questions, and to many people, some startling questions, actually, I think, particularly around sort of removing things like the systematic internalizer from the share trading obligation, which, you know, in the ins and outs, I'm not a compliance expert by any means, but you know, to remove an optionality of a liquidity pool for participants seems slightly sort of challenging in approach in my mind. You know, data now has proven, and the broad feedback has been that, you know, the bilateral nature and the liquidity being offered by ELP SIs and other SIs is actually appreciated and is providing a decent alternative. The metrics we're being judged on as an SI are more aggressive than any other public venue for the right reasons. You know, I enjoyed when the SI regime came around, having those tough questions about why it was applicable and why it was useful, because it allowed us to be much more transparent in the way that actually the makeup of our liquidity and what the platform looks like. You know, I use a third party trading platform, which allows me to have independence from a matching from a platform perspective. So we use the Aquis single dealer platform. Again, maybe a link to this whole fintech conversation, where we're utilizing some technology to give us, you know, a performant, high capacity piece of kit for people to trade on, and it gives people the confidence as also that, you know, the platform itself is well constructed, is reliable, and has a third party component to that. But I deviate slightly away. So going back to the ESMA discussion, so part of the ESMA question was, you know, should SIs be in that? And I welcomed the responses that flooded in. You know, overwhelming, I think the number was over 90% of participants said that the SI regime should not be removed, and the data proves that actually it was a very good optionality for participants to trade, which didn't surprise me, didn't surprise anyone that benefits and sees the trading. I guess it frustrated those that had lobbied for some time to remove the SI from the share trading obligations, or remove SIs entirely. You know, this is a very drastic change that's being proposed, and really the only drivers around that is to reduce competition, which seems absurd. We've spent all these years building competition and environments where people can pick or choose where they trade depending on the outcome they want to achieve, and suddenly the ESMA's asking us whether it's a good thing to take a step back. So I think the feedback was overwhelming. I was somewhat disappointed with some of the responses from some of the providers. You know, it was interesting, to say the least, to read some of those. And if you haven't, please do go and read them, guys, because it's intriguing. And we submitted a named response because we felt it was so relevant and so important to be heard and align ourselves with the messages that were coming from the buyer side and others that used us. So I guess the question then came about, you know, looking at reference waivers and looking at other sort of regulatory frameworks that provide competition to primary markets. MTF specifically, you know, MTFs evolved out of London and have distributed themselves across Europe, particularly driven by Brexit, and have a significant complementary sort of component to the liquidity landscape. And we should be embracing that as an industry. We should welcome it because it provides a much better environment. It provides, you know, data proves that dark liquidity and dark MTFs aren't a bad thing, but we still have this kind of issue. And it's the underlying, again, the point I made earlier, quite often now, and the industry feels more like it than ever before, that when someone says to me they want something, my first question is, well, why? What's your point? And clearly we're all building businesses and you want to promote your model. What we don't want to be doing is promoting a single model that creates a much more kind of a reduced environment, a reduced ecosystem. And we're seeing this from different angles, you know, whether people want to be pro on speed bumps and these kind of things. I've got strategies that would enjoy a speed bump, but then I'm not out there thinking that I want to promote that as a single option for the market, because immediately, as soon as you favor one strategy over another, you're creating an environment that's not truly competitive, which is what we should be pushing. And the data is proving that these optionalities aren't ideal. So I welcome some of the responses that came back from the ESMA, the ESMA responses that have been published now. I'm intrigued to see where this goes from here. I'm hoping those that have had a very, very loud voice on this are digesting and looking at those and using those to really kind of drive a strategy of thinking about innovation in their own markets, not looking for the regulator to restrict that innovation, which as a market participant is frustrating and a little short-sighted. And that also goes, I guess, thinking about my peer group. Some prop firms welcome certain innovation. Some would also like the regulator to step in and stop the SR regime. That's a little short-sighted when they've got bilateral trading going off on other venues that they're happy to happen, but actually the SI isn't one that can. So we need to understand, as a market and as a market participant, we have a responsibility to build the portfolio and build the ecosystem to allow people to have different options depending on what they need to achieve. And that's our role that we have to play.
Yeah, and I think we've seen improvement in that. I think the industry has become a lot more collaborative and a lot more understanding that there's things there which still leave some stuff to be desired for sure. But I definitely feel there's been an improvement of companies coming together to sort of maximize the efficiency of a lot of the regulation that we've seen recently.
Yeah, and look, you bring up a really good point. You talk about fintech. One of the things that fintech has delivered to firms like us is optionality around reporting systems, surveillance systems. It gives you an optionality which really has an impact on the underlying cost of doing business. The reality is that if you give someone that's a product that is functionally rich and is cost effective, that's only going to contribute to us growing and being a bigger sort of participant in terms of what we're doing. So, there's a number of factors that we've seen people deliver on that front, and we continue to welcome it. We should, as an industry, encourage innovation, not use regulation to try and sort of buffer back, because we're taking a step back too far. I was at the LSE when they were looking at evolving the SEAC quote-driven platform, SETSQX, which had kind of a hybrid 2-3 auctions a day, but a quote-driven component. Really, that was about bringing two different models together, the electronic component and the more kind of more manual. There's a reason why, and I guess while we are an electronic trading firm, and I will always encourage electronification of what we're doing, because I think the outcome is better for all. I understand the more complex products and the more complex asset classes maybe need a more hybrid type thing. And you often have these conversations where every 6 months we have conferences. Obviously, no one's having conferences at the moment, so no one's had a conversation for months, which is somewhat frustrating. You always get someone asking a bank, is the sales trader dead? And then they say, no, actually, and then you read sales traders are on the up recruitment. Sales traders are an incredibly important part of the ecosystem and how they nurture and provide services to their clients and the market as a whole. All these elements combine to make it a better market. You can't favor one over another. You allow them to shape themselves into an evolving landscape for all of us.
Yeah, I think that's an interesting aspect, looking at the sort of tech and business collision that we're seeing. Look, fintech means so many different things to different people. There's reg tech, there's payments, there's capital markets and trading technology. And I agree with you. Look, you look at a lot of I guess suspicion in the financial markets has been about the sort of robotizing of the industry and sales traders having had their day, et cetera, et cetera. For me, it's about utilizing all of these tools to improve the efficiency and gains, and it becomes a race to the best tech that allows everyone to the best humans alongside the best tech to provide the best results from it as well.
If I could just add one more point, and while we're talking about regulation, ESMA, one of the other things that's been very topical in the last few months was short sell bans. We saw what was really a very knee-jerk reaction to what was happening from certain parts of Europe to bring in short sell bans. The evidence is overwhelming that they're not. The unintended consequences of what they're about is bad. Disruptive, not good, reducing liquidity, hamper price discovery. These are all the things that we've got data to prove happens. But it's it has historically been a very political play. The credit to the European Exchange, World Federation Exchange, I think, came out with a very good paper, which was data backed reasons why short sell bans are not good for the market. It's a blunt instrument. It really isn't effective. It doesn't achieve what they want. It really does the opposite. So I'm glad that we've moved to a point where we have this kind of splattering of short sell bans coming in at different stages. Europe has now come together and removed those, which I think is a healthy environment. And certainly the evidence and the data is that liquidity suffers when they come in. So they should not be part of where we are. And they're very different to exchanges having various kind of technology stopping certain price movements too far. You know, that's a very different thing. So it's a very topical discussion at the moment.
Yeah, I think it sort of rolls on to the whole thing about you mentioned before about how we're only a matter of months, still, I suppose collective months, but months still into MIFiD II. MIFiD III sort of being spoken about. What's your take there?
Yeah, fascinating. Look, the MIFiD II and the work that went into was huge. You know, the draw on resource from banks and brokers and prop firms, it was enormous. So we need to treat this, that next step has to be evaluated correctly. It has to be data driven. We've now got some data sets that maybe users give us something, but again, we don't have the quality of post-trade data to potentially make the right decision. I mentioned earlier around kind of the ESMA request for feedback. Some of the data that was used there was very inflammatory around the SI regime. This SI, true SI volume is single digit. There's some complexities around technical trades and other trades that shouldn't be included in that data that currently are. So, a lot of the work and a lot of the industry has to step up and improve that sort of data by using the relevant flags and allowing us to have a true data set that should be driving decisions. So I don't know. My personal hope is that it continues in the same realms of some of the previous regulation, which is about, pro-competition, driving competition, encouraging and supporting innovation. But obviously, the forefront of all that is good regulation, because good regulation gives people trust, confidence, and that. And the market is incredibly important that we maintain that. And I know, MIFiD III is a bit of a swear word for some people, and again, I'm far from an expert in that space. I'm hoping it's a measured response should it come about, and we shouldn't ignore the fact that it draws a huge amount of resource out of firms, and it does. People stand still for a period of time, and London has already dealt with the Brexit situation. We've been ready for Brexit 3 times now, and actually, as a firm, we made the right moves very early on and ensured, we have regulatory responsibility to continue doing what we're doing from a liquidity perspective. And we have people that expect us to do that across the different asset classes we trade. So it's important for us to give continuation of business through these difficult times, which means we have to make that call. So yeah, third time waiting to see if actually this comes about. But again, it's been a huge cost and resource drain on us.
So you've been there and as you said, look, you got yourselves ready very early for that, and you've been there, and third time's a charm in terms of where they position it. Tell us a little bit about what that looks like for you. What's Brexit Ready look like?
So for us, it's we opened a European entity, Tower Trading BV, and provided and resourced that as appropriately required by the business and by the regulator, quite rightly so. So there's an investment there that we've made, and we chose Amsterdam as a destination for various different reasons. I know there's been a mixed response in some ways. So really, it's the team have done a fantastic job in terms of ensuring that we've scoped out exactly what needs to be done and what needs to be delivered, and we've got a fantastic team over there. And again, I see that from a purely business perspective as another outpost in our business, where it will give us access to talent as well as complying and meeting with an uncertain kind of time, an uncertain path that kind of Brexit has been. And again, it's a recognition to the team and Tower itself that our continuation and our investment in what we do is incredibly important. Yeah. And the output from that is evidence of that.
Let's finish on talent, because I could be speaking for a long time on this conversation, and I'm conscious I've taken you for quite a while already. There's access to talent's an interesting part of what happens. One of the benefits that can happen for businesses who position themselves in the right way from that. I've spoken to people in all sorts of places. Yours is probably my favourite home office that I've interviewed anyone with so far throughout the whole of this. But how, with regards to your talent, and have you been onboarding all the way through this? Have you seen access to more talent throughout Europe? Are you seeing a different impact on European business than the UK business as a for example. Tell us a little bit about how you guys have succeeded in looking after your people and growing and managing all of that side of things as well.
Yeah, it's a great question, and you know, great question for two reasons. One was looking after your people. One is new talent. You know, looking after your people in this environment, you know, in this crisis situation is incredibly important. You know, situations like this, people will never spend time over video like we have done. You know, and using that, and you know, Tower has always looked carefully after its staff, because staff are clearly one of our biggest assets. So it's incredibly important. So, you know, we've done that in different ways across the globe in terms of regional activities, you know, and I think, yeah, and you know, just more broadly across the industry, it's been fascinating for me where I've spent time, as well as doing constructive business conversations like this, grabbing a Zoom and a beer with a few people, I think gives an awful lot back. And I've had some really good kind of feedback from people who are saying, wow, I was kind of feeling the pressure, but actually just sitting down for half hour and 40 minutes, just having a beer and talking about non-work stuff has really kind of given me a bit of a lift. And I think historically, you know, our industry, and you know, you link it back to, there was a very good consultation done recently by the LSE around work hours and you know, the opening hours of the market, and a big part of that was about mental health and good well-being, and you know, providing a much more balanced sort of environment. And in my mind, we got to a situation now where this has been going on for a long time, and some people are feeling it worse than others. So it's really important that we're transparent and honest with each other, and look after our staff in terms of ensuring they've got access to the right conversations and all the right support, whatever that would be. You know, we've done the technology piece in terms of providing people with workstations or environments to continue doing what they're doing. The other elements have become even more important now. And I think we and others have stepped up in that, which is good to see. And you know, I think people are now becoming aware that the work-life balance now it will change things going forward. I've got no doubt. You know, I've been frustrated that we are where we are, but actually there's a few things in this experience that have really kind of picked up my enjoyment. You know, I've spent time with the kids that I'd never have done before. I laugh about this, but I didn't realize my 11-year-old could play chess. I laugh about that, but I'm actually quite annoyed with myself that I didn't know that before, because she plays with one of her friends. So I've been playing chess with my daughter in a way, and it's all which gives you that kind of uplift, which is so important when we feel that day to day there's a level of monotony in terms of where we're going through. Talent wise, and with your other question, is, you know, Tower has got a very strong record of attracting strong talent, and that continues. Maybe made a bit of a mistake with me, but you know, there's always one bad egg. But that continues, and fortunately, you know, our discussions and our work to do that and build out good trading talent and other expertise has and will continue. And we've got a great team in the various different regions that are kind of leading that charge, and with a huge appetite to continue. So it's a fascinating situation. I've got no doubt it's changing for all of us in different ways, that we're all trying to adapt and evolve. And there will be long-term changes, I've got no doubt. You know, this working from home situation and people finding that actually they can still be productive will have a long-term effect on the industry, which is going to come out in a lot of different ways, which I'm kind of fascinated to see. And I'm not missing my train journey. I'm not going to deny it, but there are other things that I am missing, have been in and around the industry more directly.
I think balance is important in that, isn't it? It's you mentioned beforehand, which is something I've spoken to so many leaders about over the last few weeks, is about the inability to have the conferences and how you adapt to not having that sort of ability to share ideas, to connect, to meet up. You know, we've got the golf course back, so we can see you chipping in on social media again from impossible angles and really utilising your golf skills. So I'm sure we'll be seeing more of that. But as that sort of slowly returns, I think the key thing that you said there is that balance, isn't it? And having a more adaptable, you know, particularly in finance, where I think it's been, you know, lagged a little bit on there, you know, for obvious reasons with traders and everything that's been difficult around that. To actually have a little bit more of a way of changing the story a little bit, I think it's going to be really encouraging and a very positive step forward for everyone's efficiency and productivity.
Yeah, no, I couldn't agree more. Absolutely.
Well, Simon, look, as I say, it's something which I could be talking to you about for many an hour more, and I'm sure we will be at various stages in the future as well. Hopefully, in physical presence and physical form. Thank you so much for sharing all your insight today. It's been some fascinating stuff to pass on to everyone. For anyone who's seen it and been interested with what you've been talking about so far, what's the best way to get in touch with you?
I'm on LinkedIn. sdove@tower-research.com is the email address. Delighted to hear from anyone, and I'm sure there'll be some constructive and some destructive feedback on what I've said or what surrounds me. I didn't paint this rainbow, if anyone's going to ask me that.
I was going to say, very good job. You've done it.
Yeah,
you've done some lovely colouring work.
I know, I agree. That's my best work. No, again, actually, courtesy of my daughter, because I asked her to do something for me and my parents. Yeah, I'm happy to hear from anyone. And look, Toby, thanks for taking the time. I appreciate it. I'm hoping that there's a few snippets of interesting bits in there, and thanks for taking the time as always. And congrats on what has turned out to be a good series of interviews so far. I'm looking forward to the others coming on as well.
Really, really appreciate it. And look, you were described to me as box office when we were told to get you on the show, and you haven't disappointed. Really, really valuable, really good content, and really lovely getting to know you. Thanks so much for your time.
Pleasure, Toby, and thanks. And stay safe, stay well, and I hope the business continues to grow. And to anyone that's taken the time to listen, thanks for taking the time, and stay safe and well. And truly looking forward to seeing everyone in direct human contact rather than this technology. Fingers crossed. Stay well, guys.
Too far
thanks
off.
again. Cheers,
Not
Toby.
too far off. Lovely speaking to you. Thanks you all for watching. We'll see you soon on another episode of Fintech Focus TV. Thanks a lot.